Hi, all. Today we're discussing the paper Does the Stock Market Overreact by Bondt and Thaler, 1985. So, the first thing is, what is the research question? The authors note that market behavior and the psychology of individual decision making could both display overreaction. They wondered what reaction would be considered appropriate and wanted to analyze the possibility that the overreaction phenomena were related by more than an appearance. An example of investor overreaction was the price ratio hypothesis, which suggested that companies with very low price earnings were temporarily undervalued because investors became excessively pessimistic after a string of negative information about the companies. The authors formulated two hypotheses regarding overreaction. One, extreme movements in stock prices would be followed by price movements in the opposite direction. And two, more extreme initial price movements would correlate with greater subsequent adjustment. Overall, the ultimate goal of this paper was to test the overreaction hypothesis had predictive power. So, what does the prior literature say? Well, prior literature had addressed certain mechanisms related to overreaction. Kahneman et al. In 1982 established previously that Bayes' rule would not be an apt characterization of how individuals responded to new data. In reality, individuals tended to overweight recent information and underweight prior data when revising their beliefs. Kahneman and Tversky stated that people made predictions following this rule. The predicted value was selected so that the standing of the case and the distribution of outcomes would match its standing in the distribution of impressions. Grether in 1980 replicated this finding under incentive compatible conditions. Arrow in 1982 stated that the work of Kahneman and Tversky typified very precisely the excessive reaction to current information, which seemed to characterize all the securities and futures markets. Additionally, the question of how could price to earnings anomaly survive the process of arbitrage was addressed by Russell and Thaler in 1985, which concluded that the existence of some rational agents was not sufficient to guarantee a rational expectations equilibrium in an economy with quasi-rational agents. Okay, so why was this research question important? The study was important as it provided insight into the overreaction effect. The overreaction effect deserved attention from researchers because the behavior principle it represented could apply in other contexts. For instance, investor overreaction can potentially explain the findings of Schiller in 1979. In terms of what data were used, the authors used monthly return data for NYSE common stocks for the period between January 1926 and December 1982, as compiled by the Center for Research and Securities Prices, also known as CRISP. The usage of monthly returns was partially to avoid certain measurement problems, such as the bid ask effect and the consequences of infrequent trading, both of which arose from the use of daily returns data. So now let's talk about figure one. So winner and loser portfolios were formed conditional upon excess return behavior prior to portfolio formation, and figure one presents the results of cumulative average residuals of these portfolios. Over the last half century, the loser portfolio of 35 stocks outperformed the market by 19.6%, while the winner portfolio underperformed the market by about 5%. Also note that the overreaction effect was much larger for losers than for winners, and most of the excess returns were realized in the month of January. Furthermore, the overreaction phenomenon mostly occurred during the second and third year of the test period. Now we're going to talk about Table 1. Table 1 presents various differences in cumulative average residual returns between the winner and loser portfolios. An obvious trend is that the overreaction phenomenon was qualitatively different from the January effect and from the seasonality in stock prices. Additionally, previous literature had suggested that the use of market adjusted excess returns was likely to bias the research design against the overreaction hypothesis, and that was evidenced in Table 1. Note that for all the experiments listed in Table 1, the average betas of the securities in the winner portfolios were significantly larger than the betas of the loser portfolios. This implies that the loser portfolios not only outperformed the winner portfolios, but were also less risky. Thus, Table 1 results likely underestimated both the true magnitude and the statistical significance of the overreaction effect. Now let's talk about slide 7. Or now on slide 7, we're going to talk about figure 3. Figure 3 shows the average cumulative average residual returns for an experiment with a 5-year long test period. Every December between 1932 and 1977, the winner and loser portfolios were formed on the basis of residual return behavior over the previous 5 years. We can see that the successive 46 yearly selections were not independent. Thus, no statistical tests were performed. Note that again, January returns on the loser portfolio were remarkable up to as late as 5 Januaries after portfolio formation. Anyway, so this concludes this video. I hope you found it helpful, and I'll see you all in the next video.